Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Steve Saretsky. He's a Vancouver-based realtor. You can find him online at stevesaretsky.com or on Twitter at Steve Saretsky. Welcome back to the show, Steve.
Yeah, thanks for having me on.
Steve, the Dow has dropped over 30% and other markets have followed suit. Is this likely to impact the real estate market?
I think that it's likely. I think the real estate market obviously works on a lag. There's obviously certain people, particularly those of higher net worth, that have been impacted by the recent plunge in the stock market, and that's going to impact some people, not only their net worth, but some of their down payment that they would maybe use for a home purchase. And so, I think just the wealth effect of that will probably have some impact on the real estate market. We're kind of waiting to see. There's obviously a ton of policy measures coming out. We're going to have to wait and see, which they ultimately come out with, how effective those may or may not be. It's obviously way too early to draw any conclusions as to, what's going to happen or how it's all going to play out. But obviously this is a huge shock, and I would expect some repercussions that will ripple through the housing market as well.
On Friday, the Bank of Canada dropped the bank rate by another 50 basis points. Then on Sunday, the Fed dropped the U.S. bank rate by a full percent. Is Canada likely to mirror the 0% bank rate of the Fed in the U.S.?
Yeah, the way things are moving, hopefully by the time we get this interview out, there won't already be an announcement. But I think that the Bank of Canada is certainly likely to follow suit. I think we're getting closer and closer to the zero bound, so I suspect that's coming sooner rather than later. I think that
the Canadian dollar has been falling like a rock because of all of these rate cuts. Is that going to affect people's ability to buy homes, or do the homes not reflect the value of the dollar, Canadian dollar?
No. I think what's sort of, potentially is one scenario, right, is you can have the house prices, rise or maybe even hypothetically stay. Let's just say, for example, for simplicity terms, you'd have the house price stay the same in nominal terms because your Canadian dollar devalues significantly. But if you price it into any other asset, US dollars, gold, or whatever, you actually have a real decline in house prices. So, generally speaking, like a weaker currency is almost one of those ways where you can kind of mask the true decline in the value of your real estate, right? So, if the Canadian dollar goes to, say, 65 cents and your house price stays the same, it's like, well, realistically, that's a real decline in the value of your home when you think about it.
We'll have more with Steve Saretsky right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Steve Saretsky. Steve, even though the central bank rate in Canada went down, the banks have raised mortgage rates by about 0.5%. Is this a sign the banks are concerned about mortgage risk?
So, it wasn't quite 0.5%. We saw a couple lenders push their rates up by about 20 basis points. Again, it's kind of changing right now on a daily basis, to be honest, from what I'm hearing within the industry, is that a lot of these big banks are trying to figure out what to do. They're trying to figure out the directions and what they should do with their mortgage rates. Obviously, again, there's quite some concern with the banks. There's some funding issues for sure. There's some credit risk for sure. And so everyone's kind of trying to figure out what's going to happen. But I think that, that certainly shows that they're not passing through the entire rate cut from the Bank of Canada is obviously a sign that they're a little bit more cautious. And so that's something that certainly is worth watching. And you have to think about it from a bank's perspective. So at the end of the day, they're running a business, not a charity, and they're in the business of making money. And so obviously, if they have perceived credit risks, if they're looking at the current scenario and saying, well, should we give this guy a new mortgage for $500,000 when, he's in the service industry and maybe he won't have a job in 2 months. So, for the bank, there's obviously some risk there. And it's such an uncertain outlook that I suspect that we'll see bank credit, tighten to some degree.
Yes, it's ironic the government or the Bank of Canada lowers rates hoping to spur the economy. But it seems to me the lower the official rate, the more reluctant banks are to kick that money out the door to actually spur the economy. Could the government at some point say you have to pass on the savings?
I don't think they can necessarily force banks to do anything, but obviously they're trying to provide additional liquidity measures. And so we've seen OSFI lower the capital ratio reserve requirements, so that allows banks to basically lend more. They've brought in their program that they brought in. It's called the IMPP. This is a program that they brought in during the 2008-2009 financial crisis. It's essentially a way for the Canadian government to essentially buy some of these essentially mortgages off the bank's balance sheets. That allows them to increase their lending as well. So they're bringing in basically all the same toolkit that they brought in during the financial crisis. So that should kind of tell you the current situation and at least how policymakers are looking at it. But at the end of the day, yeah, you can't force banks to make loans, and vice versa. Is the end consumer has to have the confidence to borrow the money. So you can lower rates to 1% if you want. You can have a 5-year fixed mortgage. Let's just say, I don't think it's going to happen, but let's just say a 5-year fixed mortgage drops down to 2%. That's great, but if people don't have jobs or they're nervous and they don't want to take on a $1 million mortgage, well, it's kind of irrelevant what the interest rate is.
Are banks likely to be more conservative in their lending going forward?
Yeah, I think that we're already starting to see that. Obviously, they're a little bit more cautious, so I suspect that you'll probably see them clamp down on issuing credit lines and home equity lines of credit. I suspect that those will probably get mitigated to some degree. So for those that are maybe thinking about tapping that, I would probably tap that before that limit gets reduced.
Are banks likely to let quantitative easing flow into the real estate market?
I don't know. They're obviously expanding. Yeah, you can debate whether the technicalities of it are quantitative easing or not. But the Bank of Canada is obviously expanding their capacity into Canada mortgage bonds, buying in the second market. So yeah, there's a lot of technicalities to it. I'm probably not the expert on that aspect of it, but I know that they are trying to obviously provide liquidity because the housing market is such a crucial component of the Canadian economy.
Is there more chatter about bank runs and bail-ins, and is this likely a real concern?
I probably, again, not the expert on that. I'm not really concerned about it personally. I think that's kind of a doomsday scenario. But, again, obviously there's some liquidity issues today. They're trying to solve those. I think, as you can see, with policymakers, central banks around the world, everyone's basically pulling out the bazookas here and firing a massive amount of stimulus. They've thrown pretty much everything except for the kitchen sink at this. So we'll have to wait and see which measures are effective and which aren't. And I think policymakers are not done yet by any means.
Is the Bank of Canada likely to continue to lower the interest rate?
Yeah, I think the Bank of Canada is going to probably hit zero. That's my thought, and you'll probably see it sooner rather than later. So, again, I don't know how much that's going to help per se, but certainly once things eventually subside, that will be a nice boost for a recovery. But I think that's likely still quite a ways away.
Now, a 0% interest rate, won't that be a disaster for pensions and insurance companies?
Yeah, it's a complete disaster. I mean, obviously we've seen that's destroyed the banking system in Japan and Europe, and obviously a lot of pensions around the world. So I think this kind of just speeds up the process, and unfortunately, those that are banking on pensions, I think they're going to be the hardest hit by this. A lot of these guys are going to be massively underfunded. So yeah, I think that's going to be a pressing topic over the next, 5 to 10 years. Is just, ultimately it is what it is. It is a pension crisis, and that's ultimately exacerbated through low, zero, negative interest rates. So yeah, there are obviously repercussions for low interest rates, which is where we've been now for 10 to 20 years, depending on what economy you're in. So
we'll have more with Steve Saretsky right after this.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Steve Saretsky. Steve, is Canada and specifically BC in or headed for a recession, and could it be a very deep recession?
I don't know. I mean, I would probably argue that you're already in a recession, to be honest. But I don't really think that you have to wait for the data to come out to declare that. I think that it's pretty obvious that the layoffs are already happening, and I mean, economic activity basically ceases to exist with majority of the world basically on lockdown and quarantine. So it really just comes down to. We're in a recession. If we're not technically in one, we will be in one. It's just kind of a matter of, how severe it's going to be. And that comes down to basically the amount of fiscal and monetary stimulus that gets thrown into the market, and ultimately how people and businesses react to that. So, unfortunately, there's going to be a lot of businesses that go under. Some will get saved, some won't. I mean, we talk about bailouts and all this, and obviously it creates a little bit of moral hazard about which companies and whatnot should be saved and who shouldn't be saved, who should be bailed out, should the mortgage holders be bailed out, should the renters be subsidized, et cetera, et cetera. So yeah, it's definitely going to be very tough, the next 3 to 6 months, and obviously, coming out of that, it's going to be interesting to see how quickly things can recover. But it's not, as we can see in China, it's not necessarily as simple as just flicking the lights on and getting your business back up and running and getting revenues back up to, where they were 100%. It's going to take some time to come back online once the dust settles and slowly, get things back into gear. So yeah, it's too hard to say how significant or how deep a recession will be, but obviously, we know that we're in one, or we're going to be in one for sure.
Could the coronavirus be the black swan that hits the real estate market?
Yeah, I mean, I think that if you're ever looking for a black swan that was going to impact the valuations, I think this would be it. I mean, if this doesn't curtail, house prices, if this doesn't, poke the bubble, so to speak, I'm not sure what else would. So we'll have to wait and see. Again, I think it's so hard to say because there's so many policy measures again coming out. Obviously, as we've talked about in this interview. Supporting mortgage holders, buying up mortgage bonds. I'm sure they'll probably ramp up the quantity of those. So how does that all play out? How do the banks react to that? There's still so much to be figured out.
Is the coronavirus affecting open houses and people looking at properties?
Yeah, so, truth of the matter was it was up until probably 4 or 5 days ago, it was kind of business as usual. And then I think over the last, 4 or 5 days, as events have really changed and ramped up and panic has really set in, we've seen a drastic change in behavior. Obviously, a lot of realtors canceling open houses, a lot of sellers saying, maybe we should pull our listing, or were initially planning to list their homes for sale are pulling those off the market and not listing them at all, and just saying, well, we'll have to wait and see, and then list it once the dust settles, so to speak. I mean, based on what's happening everywhere else, it's not unrealistic to assume that we'll be on a mandatory quarantine. So even if you want to go and view a house next week, you might not be able to. So I think that activity is certainly really basically smashed the pause button. And it's kind of, we'll have to wait and see, obviously, once things eventually resume, where the supply and demand balance is.
How are the banks reacting to the coronavirus?
I think we've talked about it already. It's just, obviously a little bit more, concerned, a little bit more cautious. Everyone's kind of a wait and see approach right now, trying to figure out, which direction, which policies are going to be implemented, what are the rates going to be, what's the risk appetite. We don't really know. It's too soon.
How are
investors trying to pull their money out of funds, may have a difficult time doing that. Again, we'll have to wait and see. It's so soon. Everything is moving so quick that, it's too early to judge.
Is more housing inventory hitting the market now that spring's in the air?
Obviously new listings were picking up, but, so were sales. So that right now, I would say inventory is still low, and, we'll have to wait and see what happens here with new listings.
How are sales in condos and detached homes?
Well, January and February were extremely strong, at least on a comparative basis to last year. March, we were on pace to see, through the first half of the month, we're looking at about a 60% growth on a year-over-year basis in home sales. Obviously, that's coming off the worst March last year, but I would say that sales were humming along, right along 10-year averages, strong demand, and obviously, it's going to take some time for the numbers to filter through. Real estate markets are extremely slow moving. A lot of these deals that are going to happen in March, the sales figures that you read about in the news headlines, were already in motion or being negotiated before the sort of fear and panic of the coronavirus really set in. So, to see or to expect real estate figures to change significantly or drastically, or to see prices, quote unquote, crash in the real estate market here within the next 2, 3, or 4 weeks, it's just not going to happen. It's just not how real estate markets function. There's not that kind of volatility. So I think anyone expecting that is poorly misguided. But we'll actually, again, like I said, it's going to take some time. If we see some drastic changes, which I suspect are probably going to happen, that's going to take several months to sort of filter through into the data.
How's the high-end market doing in the Vancouver area?
It was still soft. I mean, definitely was getting better. But yeah, it's still soft, still a lot of inventory. So, again, I don't think this is going to change anything.
Are people trying to back out of closing home purchase agreements?
Not that I'm aware of, no. Obviously, I think that contracts that were under negotiation, contracts that had, pending subjects removal, those obviously, we're seeing more of those fall apart. People obviously nervous saying, you know what, I'm not going to remove my subject clauses. I'm going to back out of this deal, before it's too late. And we're seeing that, for sure.
With a low interest rate environment, is there a comparison to be made between Canada and the U.S. today versus Japan in the late 80s, early 90s?
I think that we're kind of following that Japanification, as a general economy. Obviously a lot of debt, low interest rates, aging demographic, sort of the economic stagnation. And that's kind of what Japan's been going through for 2 decades. So, it seems like that's the case. I mean, the thought of higher interest rates or normalization of interest rates, I think seems extremely unlikely, and I think most people would probably agree with that. We can clearly see that we're going through massive fiscal stimulus here. That's all going to have to get paid somehow. And I suspect that we're basically on the early stages of basically an MMT, modern monetary theory, where essentially all this debt eventually gets monetized by the central banks. And so that seems like the route that we're on. We're on kind of the early stages to an MMT, debt jubilee, whatever you want to call it.
Steve, thank you so much for chatting with us.
Yeah, thanks, Jim. Appreciate it.
And happy St. Patrick's Day.
That's right.
As if we're going to be out celebrating.
Yeah, unfortunately not. Green beers at home.
My guest has been Steve Saretsky. He's a Vancouver-based realtor. You can find him online at stevesaretsky.com, on Twitter at Steve Saretsky. If you have any questions for Steve or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.